So welcome back to this another fascinating topic, GSII. This is very hot topic, as you might have seen. We released two papers that after long consultation. So this is very, very timely panel and heart of our hot discussion now. So my role is to introduce chair of this panel. Everybody knows, like Keith, so I don't have to introduce him, but still, very briefly, Michael McRaith, chairing this panel. Mike is not only his US Hartt FIO director and FSOC member, but in the IAIS, he is chairing our core standard setting committee and financial stability and technical committee chair. He's also leading our key project of GSII methodology task force. And naturally, he's a member of our executive committee members. Just one remark for Mike. Everybody knows Mike worked extremely hard. He arrived Monday late in the evening, and then yesterday, whole day at Tuesday, whole day meeting, and we have whole day meeting yesterday too. And Mike, of course, he is very much focused, concentrated, all complicated FSTC discussion. He managed extremely well in a timely manner, but everybody does not know that he also wake up very early, like 6 o'clock in the morning, and do exercise every day. He's extremely disciplined person, and of course, his fitness and his sound mind is critical for the IAIS. So Mike, Lois is here.
Thank you, Yoshi. Thank you, Yoshi. It's exercise, it's also called sanity. Thank you very much. We do have a very distinguished panel. We only have an hour for discussion, so we're going to try to avoid the long soliloquies and start with just a few minutes of introductory remarks from each of the panelists. Let me start with very brief introductions. Their bios are in the materials that you have, but we have Dan DeKeizer, who is the Senior Vice President for Regional Risk Management with MetLife. Dr. Frank Grund, Chief Executive Director of Insurance and Pension Fund Supervision for BaFin. Frank, thank you for being here. Peter Hartt, the Director of the Division of Insurance at the New Jersey Department of Banking and Insurance. Peter, glad you're here, and our always engaged and present and prudent colleague from Singapore, Keng Yi Lee, the Director and Department Head of the Insurance Department at the Monetary Authority of Singapore. And of course, Christian Tiemann, the Head of Strategy, Sustainability, and Public Affairs from the AXA Group. Christian, thank you for being here as well. So we'll just move from my immediate left to the far left, starting with Frank for some initial remarks.
Yeah, thank you. Good morning, everybody. As you all know, we have in our jurisdiction, there is one G-SII, and therefore we as BaFin have collected some experience with the G-SII framework since 2013, and also had and will continue to, with huge interest in the work, IAIS work related, not only but also to the G-SIIs. I think it's fair that the most recent publication of the methodology reflects both an in-depth discussion among members and stakeholders, and also a compromise that was driven by the spirit to reach a more developed stage of the methodology. Now I believe the IAIS and its members have to prove that the new methodology works, and the long-pending reinsurance question, according to my view, needs to be answered soon. The entire exercise requires huge efforts by everybody involved, but I'm confident that this year's designation can be built on solid ground. Identification of G-SIIs is an important exercise in the FSB's CFI universe. However, the IAIS made the right decision when it introduced the idea to evaluate developments over time of activities that are considered to be systemic. I believe the insurance sector is constantly changing, and we saw changes, and therefore has been reduced some systemic activities by also focusing on more core insurance activities. And thus also the risk profile of the sector should also be reflected in the final list, i.e. it doesn't always have to be 9 firms. Last point I would like to highlight is a controversial but crucial issue, that is transparency. From our perspective, it's important to move away from a hidden process. We head so far towards a more transparent process that makes even the results comprehensible and company-specific data, so far this is allowed and possible. This includes all phases of the revised methodology. We should not forget that the designation process is the trigger for supervisory measures and should therefore be rock solid. And let's not forget, Vicky mentioned it this morning, at least in our jurisdiction, we do not have a legal basis yet. As supervisors, it's our job to take justifiable decision for which we are accountable. Thank you.
Good morning, everybody, and thank you for the invitation. It's a pleasure to be here. The 3 points I'd like to make for introduction, I believe that are relevant for the process as we go ahead, are to look perhaps even more at the existing risk management of firms, to get the notion of the residual risk, because so many things have changed in the companies over the last couple of years that it would be important to take account of the existing risk management and see where are residual risks. The second issue that I believe we need to keep in mind when we talk about systemic risk and the GSII framework, that we mustn't miss out on what could be another systemic risk on the sector, namely that from low rates, which would affect the sector in a very, very different way, maybe not from the top of the largest companies, but more from the bottom. There are some notions that maybe the issue is not only too big to fail, but too many to fail. So the question of how low rates can affect insurance companies is, I believe, also a very systemic question. And the third issue is governance. We have to be mindful that we are here in a very, very special framework, which comes from the G20, sort of outside an existing treaty, through the FSB, which itself is a body that has it's a Swiss association without, again, not based on a treaty, and then to IAIS. So we have to be mindful that what we do here needs to have some relation to the existing regulatory initiatives, to the Dodd-Frank framework, to the Solvency II framework. And this, of course, has many implications. We need to make sure that we have an economic impact assessment. We need to make sure that it fits into all the existing frameworks. And we are reminded of the importance of this if we look, for example, at the MetLife case, where the fact that there was no impact assessment was one of the major points raised by the judge. I'm saying this, Dan, under your control. And we see it also in Europe, where the Commission has launched what they call the call for evidence to see what is the cumulative impact of the various regulations. And that shows us that we have to look more and more how all these things hang together. Just a brief word on the consultations papers that just came out. I very much welcome the refinement of the methodology, so compliments to all the hard work that's underlying this. You must have worked extremely hard, not just on exercising, Mike, but also on revising the whole stuff after the consultation and all the feedback that came in. I would say what is very welcome is that, if I understand correctly, derivatives are demonized, if that's the right English expression, at least as variable annuities are confirmed. I believe that one can go a step further and also de-demonize them as far as guaranteed products are concerned. For the moment, it seems to be that the guaranteed products are non-risky if they're managed through assets on the other side, but maybe it requires derivatives too, because we don't have all sorts of long-term assets. And the other point I'd just like to highlight briefly is the whole issue of liquidity, where you have, of course, refined the methodology, but I think one needs to go a step further and look at the fact that from the customer perspective, this is not money, this is long-term savings, and so the consumer behavior on this is very different. That would be my remark and introduction.
Thank you. It is a pleasure to be here. Thank you, Director, for inviting me to be part of a very distinguished panel here. As an introduction, I'll echo something that Paulo said in the earlier session, that The IAIS seeks not to supervise based on labels, but based on risk. And when we think about the G-SII designation process, I was also pleased with the evolution that we saw in the 2016 assessment methodology to take some steps towards what I'll call an activity-based assessment, actually looking at specific activities which generate risk based on their concentration, liquidity, leverage profile. And I think there's kind of across the regulatory framework, there is a move towards this. We saw the FSB and the securities commissioners take a step in this way with regulating non-bank, non-insurers on an activities basis. As I mentioned, we see a little bit of that in the evolution of the G-SII assessment here, and I think perhaps also in the court case as well, some language around the idea that being transparent with what are the activities that an insurer or an asset manager or a regulated entity is undertaking which generate systemic risk. Making sure that that's identified, transparent, and then there's a due process by which a company that is so identified can say, okay, I understand why you've identified me as being risky, and there are steps that I can take to no longer be so designated, I think is quite important. And that due process steps, Kristen, you mentioned the transparency, but I think the independent review is another component which is quite important. And then I'll echo your comment about low interest rates. And when you think about what's happening systemically in the insurance industry right now, the presence of a effectively 0% interest rate environment across much of the developed world, and as Janet Yellen indicated yesterday, an environment that may not change anytime soon, creates real strain on the insurance industry, and not just the largest players, who in some sense may be more capitalized to support that environment, but a lot of the smaller players, I think, are really struggling with their business models in a long, low interest rate environment. And kind of thinking about that, and what does that mean in when we're introducing market-based regulatory frameworks is important for us. The market-based framework will naturally be more volatile. We recognize that on the asset side, but in a 0% interest rate environment, think about the traditional actuarial techniques of discounting claims that are 10 or 20 or 30 years in the future. But it used to be that the uncertainty in that estimate kind of washed away in your reserves because you were discounting it at some positive number. You're no longer discounting that, you're just adding it up. And so that uncertainty of 30 or 40 years out makes for higher reserves and more volatility when there's a change in an actuarial estimate today. So I think when it comes to regulatory engagement based on a truly economic balance sheet, some techniques are almost a requirement in order to stabilize that volatility. And so I think we'll talk about that a little bit more in the session as well.
Thank you. So it's also my pleasure to be here at this panel in this beautiful city, Hungary. So just a few comments. So today we released the 2 documents, and that's really the hard work that's been done by the 2 task forces, ably led by Mike and Alberto, and also the task force members putting in a lot of effort to take on the various views. And I think I'm confident to say that we have a better methodology today, a due process that's being mentioned, a structured process to go about designating the G-SIIs, and also addresses many of the comments that came through for the reinsurance assessment, giving clarity to how systemic risk is being transmitted from the insurance product features. I think these are all very important improvements that we have made. As a host jurisdiction, this is something that we are interested in because we are part of this ecosystem. And many of the G-SIIs operate in our jurisdictions, and also we are interested to see how they contribute to financial stability. And I think on that note, I also want to say that this is an evolving process. We'll continue to look at how systemic risk is being transmitted, and that there will be improvements to the methodology in the future to come, and that it's not something that is static at this moment. Yeah, thank you.
Thank you. I'd start by acknowledging the tremendous job that Mike did under what were, frankly, some pretty arduous circumstances. This was a very intensive process, and it was difficult to achieve consensus. So, Mike, you deserve a lot of credit for guiding us to this result. And this result, in my estimation anyway, certainly represents some very significant progress over the prior methodology 6 things in particular stand out to me. The first is the introduction of cross-sectoral analysis, albeit only in some areas. The second is the ability to consider a range of mitigating factors before making the determination. The third is a formal process for prospective G-SIIs to present information or counter-arguments before a final determination is made. The fourth is the prevention of double counting of derivatives, such that the use of them for hedging purposes is not penalized relative to a company that didn't use them. The fifth is transparency, particularly transparency to the firms on how they scored on the assessment and why. And the sixth is a clear, structured, phased approach that balances quantitative and qualitative factors. I mean, the mechanics of this process are really much improved, and that will be helpful to us as we seek to make additional improvements going forward. So, that's the good news from my perspective. The bad news is we don't yet know if it's going to work, if it's going to produce a list of G-SIIs that makes sense. And there is reason to believe that we have not gone quite far enough yet. 3 particular challenges appear to me. The first is that there is a continued reliance on relative rankings, for most indicators. Yoshi made a comment about how Mike exercises every morning. So Mike runs a lot faster than I do. He can run faster and longer than I can, by a long shot, okay? He'd whoop me in any foot race. But that doesn't mean that he's qualified to compete in the European Cup, right? So if we want to know whether somebody's qualified to compete in the European Cup, we need to measure their performance and their skills, and then we need to compare those measurements to players that we know can compete in the European Cup, right? That's not what has occurred in the GSII methodology process when we have relied on relative ranking. We have not compared these insurers to actors that we know have systemic potential. The second thing is there's continued disagreement among regulators on mitigating and exacerbating factors. I mean, there are things in this document that have been identified for consideration in phase 3 that I think most of us in this room, or maybe I'm wrong, but at least many of us in this room would find to be very clearly mitigating factors, and significantly so, but that some regulators insist are also potentially exacerbating factors. So we have to figure out a way to resolve that disagreement. The third thing is there continues to be a lack of clarity on the ways in which the risks we've identified are actually transmitted to the global economy, and not just transmitted to the global economy, but transmitted to the economy in a systemically significant way. Connected to that, there continues to be, in my estimation, some confusion about the difference between risks to the firm and risks of a firm's failure on the economy. Just because something bad happens to a company doesn't mean that something systemically bad happens to the economy, so we need to work through that. And so I think these are the primary areas to focus on as we go forward, both on implementation of this methodology and in the development of the next methodology. And we should do this, let me just conclude by saying we should do this not just because we want to build a better mousetrap, we should want to do that, but because there are significant risks involved in not getting it right and significant costs. Thank you.
Excellent. Thank you all very much for those remarks. And Peter, let me start with you. Thank you for your kind words, of course, but you were there at every step in the process as well. So you're aware that within the ranks of our group, very diverse views, very smart people, capable people, well-intentioned, well-meaning, but very diverse views. And there were some views that I think are held within the stakeholder community as well, that the methodology should be entirely quantitative or empirical along the lines of the G-SII approach, and then others of a view that the approach should be far more activities-based, much more like the approach for the non-bank, non-insurance initiative globally with the asset managers. So first of all, what is your reaction to that dynamic, and which approach do you view as more appropriate and why? And then after Peter's response, I welcome input from any other panelists.
Yeah, thank you. So I have some discomfiture with a purely quantitative approach. I think the differences between insurance firms and the differences between the insurance business model and the banking business model argues strongly for some qualitative kinds of considerations. I'm not sure, though, that an activities-based approach is necessarily qualitative. It could be a quantitative approach. You know, activities-based approach to me is very appealing conceptually because, of course, what we're talking about when we talk about systemic risk, we're talking about the activities of a firm. The firm itself is not systemically risky, right? Or if it is risky, it's only risky because of its activities. There's also an issue of potential risk in missing potentially systemic activities of firms that may be outside the pool for whatever reason, because we have a metric that is so focused on identifying companies instead of on identifying activities. So conceptually, I find the activities approach very appealing, but we have to decide what it means, right? We have to have that discussion. What do we mean by activities? Is it purely quantitative? Can it be? Should it be some balance like we have in this methodology?
Other comments from panelists? Dan?
Yeah, I'll just add a couple of things to what Peter started with on activity-based. I do think your point about looking across the actors regardless of legal entity is an important one, but it does create a challenge for the regulatory environment. So much of our regulation is built geographically and jurisdictionally, right? So there are regulators for insurance companies and there are regulators for banks. And when we think activity-based, that requires us to kind of take a step back and think more broadly across the economy as to who those actors are and how they are contributing to a systemic impact. But that also gives us an opportunity perhaps to make the regulatory effort more focused and more effective. The opportunity to build clearinghouse type activities, which then can get consistent data all in the same place to understand who's holding an concentrated or an outsized position on one side or another, can exist when you look at the entire framework rather than a particular type of legal entity. I think it also captures the risk, which if you kind of go size-based, it just happens to be that the G-SIIs that have been named today are among the largest insurance companies in the world, but if you take kind of that size base, you miss small companies with particularly outsized risks, may have transmission channels which carry that risk out to other entities outside of the regulatory framework. So a couple things to think about that I see as values of the activity-based approach.
Thanks, Dan. Any other? Kang Yi, let me ask you, when we look at whether from the perspective of one of the world's most prominent host jurisdictions, a hub for many international firms, including G-SIIs, when you evaluate whether an insurer is globally systemically important, to what extent should, when the IAIS evaluates this question, to what extent should we consider the authorities or the powers of the supervisors in the markets where the firms operate?
I think it would be useful to consider the perspectives of both the home and significant host jurisdictions, because that gives the context to understand the quantitative indicators as well as the qualitative process. So it validates the understanding of systemic risk. But at the same time, I would like to caveat that the perspectives should be taken on board together with the other many inputs and perspectives under phase 3. So I'm not suggesting that any particular jurisdiction be given a higher weightage, but I think their explanation can give the background and the context for us to better understand why the G-SII is a G-SII, and that could be considered together with the many other inputs throughout the process.
Excellent. Other comments on this question? Okay, you said it all, Kang-Yi. Dan, let me turn to you. So there's been a lot of discussion of trends within the insurance sector. We, in the new methodology, will be tracking trends within the sector more closely than we have historically. And that'll be helpful, I think, to us as the IAIS as we evaluate global activities, global developments, and whether there are additional concerns that we should highlight or that we don't need to be as concerned with. But from your perspective, since the crisis, have you seen the industry increasing or decreasing activities or products based on concerns related to systemic risk?
That's a good question, and I'll actually echo one of Peter's comments that there are activities which are risky for a firm, but not systemically risky. And I think a lot of what happens in what I'll classify as traditional insurance, I'm working with somebody who has a risk and they want to transfer that to me as an insurance company. I think very little, perhaps even none of that is systemically risky, even though it can be risky to a firm. Where I see the aspects inside insurance companies which potentially have the systemic impact is in the use of derivatives, securities lending, repos, the asset side of the balance sheet where there's a closer engagement with the rest of the financial sector. And I think in all of those areas we have seen insurance companies either reduce their presence in those areas or place more robust governance structures around them to enable them to operate them in ways that are less risky to themselves as firms and potentially systemically. The other aspect that I've seen, particularly in the last few years, has been a reaction, as both Christian and I mentioned earlier, to the low interest rate environment, which has made hedging activity more costly for a variable annuity type business or unit-linked business with guarantees. And as a consequence of that, we've seen companies raise prices, and therefore that's going to be less commercial, and you're going to reduce your presence in the marketplace on that. Or even just a classic whole life product or a long duration term insurance product, which has an explicit or implicit interest rate guarantees. Those have become more expensive. And therefore, you see companies, particularly the larger companies, moving their guarantee rates down quite rapidly. And I think this raises a question for us of a social cost of that environment as well. Insurance has real social value and the ability of individuals to take on risks and to protect their family, the ability of institutions to take on risks. And in an economic environment like the one that we face today, I think there's a social cost to that interest rate environment, which we are seeing insurance companies react to.
If I could add to that, I would say there are three interesting elements. One, size is sort of reconsidered in a way. I mean, I think it should not surprise us that there are no major global M&A transactions in the sense that I think, the size is no longer increasing. People have understood that there's a question mark around that, and that has an impact, I would say, on the industry. Second, I would say there is a very interesting and important business line diversification going on, and maybe partly related to the low rates, maybe partly related to a regulatory environment. I see many large companies going more into health business. I see many large companies going more into some emerging markets and diversifying this, and rediscovering the corporate business. There where we have seen M&A transaction in the US was especially in the corporate insurance market. So that's the second element on the business line diversification. And on the life insurance, which is after all the bread and butter of what we're talking about, I also see major shifts away from heavy capital to capital light products, to sort of hybrid products, to unit-linked products more and more. I see changes in the variable annuity business, very significant. The nature of guarantees has changed. The nature of richness of guarantees has changed. So I would say there has been very, very significant changes going on in the insurance industry recently.
Yeah, just to add one point, I think absolutely true. We see these shifts in the portfolios. What is an increasing, it might be a risk, is transparency, lack of transparency for the consumer. And in fact, it means that we are transferring of the still existing risks to the consumer. And I think that has been, I think, at least not in our market yet, been fully understood. And that I think we have to manage. That will be an issue we have to work on, how to have a fair treatment of the customer. Transparency, consumer protection, I think it becomes more important due to these evaluation. Thank you.
Excellent. Peter Kengi, let me follow up with a question. Globally, there is, in many countries, either an increased desire for private sector retirement security options, or just by virtue of systemic challenges, a trend away from defined benefit, publicly supported defined benefit plans towards public sector options. How do you view that as a concern for financial stability, or do you not see a nexus between that trend?
I would say this movement is clearly taking place from defined benefits to defined contributions. I would say it has less relationship to what we are discussing here more than the low rates and the question of longevity and taking these risks. So I think that is indeed something that is going on, but that is almost larger than ourselves. So it's not just linked to the current regulatory environment. This is really linked to the demographic environment, to the fact that retirement age is moving less fast than longevity is moving. So we see, the retirement issue being much more present. So I think that's more related, I would say, to the macroeconomic environment, low growth environment, and the rising longevity, which is a big issue.
One thing to add to that, our colleagues in the pension fund industry, who probably not very many of them represented here, but they face many of the same issues that insurance companies face in this economic environment and the regulatory environment. But certainly this shift, as Frank pointed out, this shift from risks that were retained and then paid off by insurance companies or even by governments have moved to the individual. And the individual may not be fully aware of the risks that they are taking on, so there's a disclosure obligation that is on us as companies to do that, but they may not be purchasing a product for a risk that they now have unknowingly taken on because either their government or their company has backed away from a provision for retirement security. And I think that is a challenge for us and our colleagues in the pension industry to solve because the amount of savings that is necessary for the length of time that people think they will be able to have and live in retirement is substantial. Right?
Yep, and I know, Christian, you want to weigh in on this again, but the question that I would ask is, there are people looking to replace what were defined benefits with an annuity product of some sort, which means there's some guarantee connected with that. And so the prevalence of those guarantees is increasing in some sense. And does that then, how is that reflected in industry financial risk management, I guess would be the question, because you want to provide these products, right, as an alternative to a public pension system. Well, I'm happy for either one of you.
We would love to provide those products, but you have to provide them in a way which is appropriate from a risk management standpoint, from a capital standpoint, and guarantees are expensive. If I walk into the street outside and ask somebody, please give me half of your income today so that I can pay for your retirement when you turn 60 and for the rest of your life, they will not buy that product. And yet that might not be an unreasonable price in a 0% interest rate and a 80, 90-year lifespan, right? So what people are willing to buy, given the economic environment, the regulatory, the capital environment, and what they actually need, there's a gap there, I think.
Yeah, Mike, your question is the 10 trillion, whatever, dollar, euro question. I think it's useful to think the following. That normally there's, as you know, the triangle of desires. People want return, guarantee, and liquidity. Return gives them the income they need to retirement, guarantee gives them peace of mind, and liquidity gives them flexibility. Normally, that's up to the insurance industry to provide, to fulfill this triangle of desires, if you like. In the low interest rate environment, we realize that's completely impossible to fulfill this triangle, and it may even be difficult to fill just 2 points of this triangle. It's even difficult to do return and guarantees. And it's difficult to do liquidity and return guarantees. So what we have seen is at the beginning of the low interest rate environment, the sector and the people move towards unit-linked products. Saying, oh, we want returns, and that's where the returns are. Then, however, China happened, we saw the stock market decline, and then the people come back and say, actually, we also still want some protection. We want some guarantees. And so the question is, what can go in this equation? My sense is, if we think regulatory long-term, the only issue that we have to be mindful of is people need a return, because even though inflation is very low, the price for housing and healthcare, which are the two long-term savings motives, are rising very significantly, 3 to 6%. So people need a return. Second, my sense is people need guarantees. They want some sort of protection. So maybe the question that we can give up is liquidity. Maybe we have to design more and more long-term products that will allow the insurance industry to invest in such a way to give returns. So to answer your question more precisely, that's exactly this triangle which I would say the industry is working very hard to find the best optimum combination. And we are thinking maybe we have to lower guarantees from 100% to 90% in order to at least give some guarantees. Maybe we have to be more active on the asset side to try to get some returns. So this is exactly the triangle we're optimizing in.
Excellent. Good. Did you want to add any more to that, Frank? Okay, let me turn to you, and we have a few more questions, and then we'll turn to the audience for questions that you might have. But Frank, as we look at the notion of globally systemically important insurer, one of the dimensions to that analysis is the importance of that insurer within its largest market. And how do you think about that? How do you weigh the consideration of whether an insurance firm is systemically important in its largest market versus whether it is also a globally systemically important firm?
Yeah, obviously it's a difference, domestic importance versus global importance of an insurance group, that's clear. If a firm is domestically important, it's not necessarily globally important, and vice versa. For example, if the company does not have any subsidiary, internationally active subsidiary, and so on. But vice versa, a firm could also have a global activity which could be of such a size that it could be systemic, but at the same time it's not so systemic at the national level. I think that's rather straightforward. So domestic importance is for me not a conditio sine qua non for internationally systemic risk. And also the designation, and that is more the process or the formal aspect of that question, that must not necessarily be linked, because the thresholds, the definition, the criteria could be totally different. The processes which have to be followed could be totally different. So I would say there is not a necessary link between a domestic designation or not designation and an international designation.
Okay. So it's not a binary
Yes.
question from your perspective. Any other thoughts, Kengi? Do you have thoughts on that question? From the perspective of a host country supervisor.
So I agree with Frank. I don't think they need to come together per se, although I agree that it seems uncommon to have a GSII that is then not systemically important in its biggest markets. So I think that's not common, but at the same time, I think it is possible for that to happen because being globally systemic and cases, it being interconnected to other markets, and I think from a host perspective, that's important to consider whether it can transmit systemic risk to other markets and not just be focusing on its largest national market.
Peter? Okay. Let me, Christian, turn to you, and this is a subject that Peter also mentioned, so Peter will look for some follow-up from you. Christian, as you consider risk management that insurers employ and that are reported in the systemic risk management plan and other ongoing planning for the largest, most complex firms, how would you encourage the IAIS to think about those risk management approaches within the context of evaluating systemic importance?
For me, there are two questions that would arise from this. One, I'm thinking, of course, here from the viewpoint of a company that eats and breathes Solvency II. And as you know, Solvency II is perhaps the most advanced and complex, but also comprehensive risk management framework that captures market risk, credit risk, counterparty risk, longevity risk, morbidity risk, mortality risk, counterparty risk, credit risk, lapse up risk, lapse down risks. So the question there is, what risk are you aiming to cover that is not yet covered under Solvency II? That's the one question. I think that's the notion of residual risk. It would be hugely valuable if you could clarify that, because that would help us to integrate and say, okay, there's something we have overlooked. That maybe because Solvency, of course, did not have the systemic notion in mind. It was done under different auspices, so it has its own framework, but the company is applying this. Many E-SIIs or G-SIIs are applying it. What is the risk that you're aiming at that is not yet covered in Solvency II? That's one question. The second question is that we have been providing, as you mentioned, all these reports, the Systemic Risk Management Report, the Liquidity Management Report, the Recovery Report, and we have contributed to the supervisors to establish the resolution regime. And the question would be, what is the IAIS doing with this?
I think I don't disagree with that, but the main, or one of the main aspects, which is a very positive one, you did it, you understood your risk, you understood the mitigation measures, and that is, I think, the most valuable effect of all these discussions, and let's not undervaluate that. I think that's very, very important, but I agree the dialogue between supervisors and companies could be even strengthened and fostered, and that would come then to an even better result, probably.
If I could just react, I mean, we have a very close dialogue. I mean, the ACPR is here, so I speak under very tight control, but we do everything and have a very positive and very constructive relationship. And Frank, if I can say one thing, also the industry has changed. As I said earlier, the behavior has changed, the product mix has changed.
Thank you, Christian.
So I think, as a lot of people know, I've been an advocate for considering risk mitigants of various kinds in this analysis and in the methodology. That includes risk management within the company. It includes ways in which supervisors mitigate risk. It includes policyholder protection schemes and guarantee funds. It includes the ability of supervisors to impose stays to prevent runs, and many others. I recognize that because such mitigants vary from jurisdiction to jurisdiction and company to company, that an extra layer of analysis is needed in order to account for them. But I think it's a worthwhile effort, because what is this project about, right? The project is about identifying stuff that could actually hurt the global economy. And we are not, to put it simply, able to identify stuff that can hurt the global economy in actuality unless we have accounted for the mitigants to prevent it. That seems to me fundamentally true. So I think we should continue to move in that direction of adding that layer of analysis. We've made some good progress, I think, in the methodology document that we have now, but we should take some additional steps so that we can really bake that in going forward. And let me just say that, and the reason is because, again, because that's how we actually identify actual risks to the economy. And if we fail to do that, then we have enacted a regulatory scheme that has significant costs, okay? Significant cost to firms and to consumers, has a significant potential for introducing risks and unintended consequences, and we've done it for what purpose, right? If we haven't actually identified the actual systemic risk. Thank you.
Great, thank you, Peter. So, Kengi, did you want to supplement? And if you have a question, if you wanted to step up to the microphone, we'll turn to the audience in a moment.
So I don't disagree with what's been shared. I think it's a valuable process for the G-SII to do all these plans. But at the same time, as Peter has mentioned, it varies from firm to firm and jurisdiction to jurisdiction. So that needs to be judgment and it'd be qualitative. So I guess the question that I would have is that in times of crisis, to what extent these risk mitigating measures would certainly work. So I think it's the certainty of it that we are concerned with. And so while we want to take into consideration, we also need to be mindful of how circumstances can change, and in a distressed environment, some risk mitigating measures may not work as well or as effectively. So I think that's just one perspective. Yeah.
Yes, great, thank you. So questions, we have roughly 5 minutes remaining. Any questions from the audience? Is that clear? Excellent. Al Ayupa.
I thought we weren't supposed to identify ourselves. I guess my question is, I mean, we talked a bit about the GSII methodology that's out there in the revisions now, and haven't looked at the newly released yet. But one of the things I think that concerns me, or at least cognizant of, that as a non-GSII, it's difficult for us at times, and has been, to sort of fully appreciate our position relative to the firms that have been designated. And in some cases, our relative ranking within your scope is contingent not on any actions we may take, but on actions being taken by other firms. Have you tried to build in any sort of protections within the new methodology to address that situation or that type of scenario?
Yes, thank you for that question. In fact, the new methodology has constructed an entirely new transparency regime that is unprecedented, so that I think it's paragraph 82, Al, of the 83-page document, 83 paragraph document. You'll see that for those firms that are involved in the GSII exercise, meaning providing data, but are not identified as GSIIs, there will now be the opportunity for that firm to understand what are its scores for the indicators. Now, and then what are the average scores for those indicators, and what was the cutoff number following phase 2. So there will only be, obviously the confidentiality is in first priority for us, so there will not be any indication or any context for a firm to kind of triangulate where other firms stand, but there will be clarity for that firm about where it stands with respect to the broader pool of insurers involved in the process.
And maybe just a follow-up question from me for either Peter or Mike. I believe there's also some absolute rather than relative rankings, like measurements across sort of an industry position.
That's correct. So one of our objectives with the revisions was to improve the scoring or evaluation in comparison to the broader financial system, not just within the relative scores of the pool of insurers involved. Peter mentioned this before, and there is, again, varying degrees of enthusiasm for this initiative, but there are 3 indicators for which there will be absolute reference values: reinsurance, financial guarantee, and derivatives in the interconnectedness category. We could spend hours talking about the technical aspects of these things, but you'll be able to read about them in the materials that were released earlier today. Any other questions from the group, from the audience? Yes. If you could please introduce yourself.
Diana Keegan with MetLife.
Thank you.
Looking very briefly at the documents that were released this morning, I'm thinking and hearing many, many comments in the 2 panels today, and specifically this panel about the desire to move forward with continued improvement, continued discussion, the collection of data such that further analysis can be done. One thing that strikes me is that there continues to be a reference within the assessment methodology paper to it only being reviewed in 2018. And I'm wondering if the IAIS could consider keeping that more open, more fluid, because it's obvious that we're looking really at something which is going to continue to be an iterative development process. Thank you.
The methodology will be reviewed on a 3-year cycle. We need some stability in the process and the methodology in order to learn if there are areas where improvement is appropriate. So while we'll be learning as we move forward, the revisions will occur on a 3-year cycle. Okay, so we are at 12:30 on my watch. Again, thank you very much to the panel for your insights. We could talk many hours about this topic, and undoubtedly we will, just not in a public space. So thank you all very much.
Thank you very much.